right? Not 2 meetings ago, he was like, soft landing, or actually no landing, right? We're not even going to land this plane. We're just going to take off again. We're going to do a touch and go, and life is good. And now, well, we can't have soft landing as our base case. Of course, it's your base case. That's always been your base case. I mean, you're telling us there's what? A medium landing? Is this the Chuck Yeager definition? Any landing you can walk away from is a good landing. And if you can use the plane tomorrow, it's a great landing. I mean, I don't know. It's confusing.
On Friday, U.S. Federal Reserve officials issued a warning of potential future interest rate increases, even after voting to maintain the benchmark federal funds rate at its current level during this week's meeting. 3 policymakers expressed their uncertainty regarding the completion of the battle against inflation. Their remarks were cautious, featuring terms like patience and an acknowledgement of the slowing rate of price increases. In their first public comments following the central bank's decision to keep the benchmark rate within the 5.25 to 5.5% range, the emphasis was on the possibility of future rate hikes. It was also highlighted that monetary policy would likely remain stringent for a longer duration than previously anticipated. According to Fed Governor Michelle Bowman, inflation is still too high, and I expect it will be appropriate for the Federal Open Market Committee to raise rates further and maintain them at a restrictive level for some time to bring inflation back to our 2% goal in a timely manner. She mentioned that progress in controlling inflation is expected to be gradual, even with the existing level of monetary policy restraint. Notably, recent Fed projections indicate that inflation will remain above the 2% target at least until the end of 2025. Mark Yusko shared his insights about the Fed meeting and its potential impact on the market. He also highlighted the increasing Treasury holdings by countries that could emerge as rivals, along with concerns about deflation and the bond market.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
You know, this idea that the market still, after all his protestations to the contrary, actually believes they're going to start cutting rates. Now, not as much, but they're going to start cutting rates in March. I mean, March is not that long from now, right? And so that I just find the whole thing kind of interesting. Is the Fed chair says something, and it's been going on for the past few years, and people are just like, yeah, whatever. I'm going to believe the opposite. And in some ways, there's a directionality that's right. You know, people for 7-8 years said Fed's going to raise rates, and the upward slope of the Fed futures curve was consistently wrong for 7 to 8 years. And then suddenly it was understated because, he cranked up, the knob to 11. And now they're going to be consistently wrong on this downward slope. And I just find the whole game kind of silly. But that said, I think there's a bunch of things that came out of this that are interesting and confusing in a way, right? Not 2 meetings ago, he was like, soft landing, or actually no landing, right? We're not even going to land this plane. We're just going to take off again. We're going to do a touch and go, and life is good. And now, well, we can't have soft landing as our base case. Of course, it's your base case. That's always been your base case. I mean, you're telling us there's what? A medium landing? Is this the Chuck Yeager definition? Any landing you can walk away from is a good landing. And if you can use the plane tomorrow, it's a great landing. I mean, I don't know. It's confusing. And then the last part is rates. Rates are in free ascent. Forget free fall. They are in free ascent. And that's kind of contrary to this idea that they're going to offload their balance sheet. So what you're telling me is you're going to sell bonds at a loss? I mean, if you acquired all these bonds at low interest rates and now you're going to sell them at high interest rates, where does that money come from? because remember, the Fed is not federal, so they can't get it from the government, and has no reserves, right? There's no there to plug that hole. So I don't know. I find the whole thing kind of curious. Every once in a while, you'll find in that total number these odd things, like Belgium is buying a lot of bonds. Like Belgium doesn't have any money. Well, it ain't Belgium, right? It's some Saudi prince or something, running it through the ECB. Or, the UK, that's my other favorite, because that's really the Saudi money that goes through the UK, or African dictatorship money goes through London. So you got to actually look at that, because if Japan is net sellers and China's net sellers, those are the big dogs, and Russia is not really that important, but they're net sellers. The net buyers, and this is the other interesting thing about this, is if your plan is to just screw over your enemy, right, who borrowed a lot of money at low interest rates, you could do that. And that's what this guy was positing about China, is that we are trying to exacerbate the collapse of the Chinese real estate market to put pressure on China. It's an interesting theory. I mean, it is. But it's interesting. You look at Evergrande stock, for example. It's rebounded off the bottom, like really, really hard. I mean, should have gone to zero based on the data, but like Citigroup, same thing. Citigroup should have gone to zero, but it didn't.
In the new projections released at the conclusion of a two-day policy meeting on Wednesday, it was revealed that 12 out of 19 Federal Reserve officials anticipate an additional quarter-point rate increase to occur within the remaining course of this year. The Federal Reserve has 2 scheduled sessions left in 2023, with the last 2 meetings set for November 1st and December 13th. What's more, officials notably forecasted that while they still intend to initiate interest rate reductions next year as inflation subsides, the pace of these reductions will be slower than initially envisioned. Although there are varying viewpoints among policymakers, the current consensus among them indicates a projection of only a half percentage point reduction in rates for 2024, as opposed to the full percentage point decline that was envisioned in their June quarterly outlook. Mark Yusko now delves into the complex topics of deflation, debt bonds, and treasury holdings. Let's hear his insights on these matters.
The reason you have secular deflation is old people. And look, it is a fact that every single day for the next 13 years, something like that, 10,000 people will turn 65 in the United States, and another 10,000 will turn 65 in Europe. And Japan's already 11 years ahead of us. They're starting to age into the 85-year-old cohort. And you look at those places, and it is secularly a downtrend in inflation. And the only thing that's going on now, again, this is just the debate back and forth. Oh, but we have this 70s style inflation. No, we don't. We had a currency devaluation, the likes of which we've actually never seen. Right? Think about that. The United States had a currency devaluation we've just never seen. We printed half the money in the history of the Republic in 18 months. And now the chairman is like, shit, that was too much. I gotta claw some of that back. But here's the problem. And this is going to get into the little theory that I was talking about on China. Here's the problem. How exactly, Jerome, are you going to reduce your balance sheet? You are the buyer of last resort, the lender of last resort. So you bought up all these bonds. Who's going to buy them from you? China stopped. Russia stopped. Japan stopped. They're actually divesting. They're exacerbating your problem. So who exactly is going to buy bonds? Oh, we're going to freaking stuff them into the banks. That's gone. You did that. You put them in the banks, and then you went and jacked up rates, and you bankrupted a whole bunch of banks, like wiped them out. Why would you do that? You're supposed to be the banker in chief. Why would you bankrupt? Okay, that's a whole nother story. That's to set the stage for CBDC. You have to foment fear and distrust in the banking system. So the banks aren't going to buy them. So who exactly is going to buy them? Us. 65 to 85-year-olds. Well, I'm not 65 yet, but I will be. Old people buy bonds. They don't buy green bananas, and they buy bonds. And that's their only hope. And I've said for years, there's no law yet that forces you to buy bonds in your 401k. And, we've talked about this. I believe it should be against the law. Literally, there should be a law that prohibits anyone under 65 from owning a bond in their 401k. It's the dumbest investment decision you could ever make. But they could actually, and I think they might, and there's actually been bills thought of that would mandate that you buy government bonds in your 401ks. Be horrible. But wait a minute. If interest rates are 5.5 or 6, isn't that a good thing? Well, if inflation returns to its persistent decline at, sub 2%, 4% real, it's not bad. It's not bad. But I don't know who's going to buy the bonds from Jerome. I don't know who's going to do it. So good luck with that, J. Powell.
Amid concerns about the safety of its overseas assets, China has been consistently reducing its holdings of U.S. Treasury bills for the fourth consecutive month. In July, the country unloaded $13.6 billion of U.S. debt, lowering its holdings to $821.8 billion. This marks a 14-year low, a level first reached in June. China's divestment is attributed in part to aggressive U.S. interest rate hikes that have affected bond prices. The Federal Reserve, along with other major central banks, is nearing the conclusion of a rate hike cycle that began in March 2022. As a result, analysts suggest that Chinese policymakers may need to reevaluate their decision to divest from U.S. Treasuries. The reductions in U.S. Treasury bill holdings have been significant, with China divesting $191.4 billion between March 2022 and July, while other countries, such as Japan, Ireland, Brazil, and Singapore, have also reduced their holdings. In addition, China downgraded the U.S. from its AAA credit rating status in August due to concerns about the country's fiscal outlook and prolonged debt ceiling negotiations among American politicians. These developments raise questions about whether other nations will wield their treasury holdings as a strategic tool. Share your thoughts in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.